demand for leases is going higher because farmers are trying to save on cost, and it's cheaper in the short term to lease rather than to buy a new machine.
Hi, once again, everybody. Welcome back to the Comstock channel. I'm Marlin Bohling with you. So glad you could join us today. And we're getting ready to wrap up another week. I want to encourage you to like these videos and share these videos with others. You can subscribe. In other words, we'll let you know every time we post a new update. Just click on that little bell icon down below and we'll notify you each and every time. Well, today my very special guest is Tanner Ehmke. He's back with us again, and he happens to be the lead economist for grain and oilseed with CoBank. He works in the Denver location, and always good to talk with you, Tanner. You are from the plains like I was, so I guess we kind of have a bit of a connection that way. But as we record this, we're recording on a Friday, and the grain markets are trying to claw their way back, but they're hovering near lows, if not contract lows, near long-term lows. And the cattle market has just been getting crushed the last couple of days of this week. As we got into August, it's like cattle fell right off of a cliff. So where you look at everything from the economic point of view, that has to make you kind of nervous the way the ag economy is situated right now. It looks kind of precarious, doesn't it?
There's a lot of bad news that we can start picking apart here, Marlin, and as all the things you outlined right there, does raise some eyebrows about where this is all going. You'd mentioned what's going on right now within cattle, big drop there, and that was following some concerning economic data. The jobless claims are up. And you look at some of the other macro data like slowing wage growth, job openings are coming down. So clearly this is an economy that's been slowing. I think we've all seen this coming. Sometimes the market just kind of finally has a sudden reaction to the slow moving thing that a lot of us are watching. But we've known the U.S. economy is slowing. The Federal Reserve this week had said that rate cuts are clearly on the table. They thought it was too soon to be cutting in July, and already here we are, second day in August, and intimating that we'll probably see some rate cuts in September when the next time they meet then. So we can anticipate that happening, but the data right now is clearly showing that this is a slowing economy, and so that's really impacting the livestock end of things. I'm hopeful, on the other hand, Marlin, for grains, because what does this mean then for the value of the dollar? When you have a slowing economy, you're going to have a weakening of the value of the U.S. dollar. In theory, this is always in context of what happens in the rest of the global economy. If the U.S. economy is weakening faster than, say, the European economy or the Chinese economy or the Mexican economy, then our currency is going to be cheaper relative to theirs. And what that would mean then is we would see stronger export business for U.S. grains. We're very influenced by what happens with the value of the dollar when it comes to our exports. So I'm hopeful that there might be a silver lining in all this bad news, that we could start to see a weakening of the dollar, and that would be a tailwind for our exports, because we have really struggled on our export front because of supply surplus, big crops in South America, big crops elsewhere. We did have a smaller wheat crop over in Russia, but again, a currency situation there. They've got a weakening ruble versus the dollar. The Brazilians have had a weakening real versus the dollar. And so we've really had to struggle against that dual headwind of big crops in South America plus a weakening real. And so that has really caused us to be concerned. So hopefully my hope here is that amidst all of this bad economic data that we've seen this week, with jobless claims up, wages coming down, that we will see hopefully a weakening of the dollar that will hopefully move some more grain sales out the door.
It's such a weird dichotomy where, all year long, people have been hoping for rate cuts and pushing for rate cuts. We need rate cuts. We need rate cuts. And then they kind of send a signal they're going to cut the rates, and then everything goes to pot. connect those dots. How does that work now? I mean, connect them all the way back to the grain or livestock trade. Why would it be so hard, like on cattle right now?
Well, let's start with the Fed's objective. They've got the dual mandate: stable employment and stable prices. Well, prices are still high. Inflation is still above their 2% target. Now, inflation is nearing their 2% target. When you look at their preferred gauge, which is the PCE, that deflator is what they look at instead of CPI. That's falling quickly and it's heading towards 2%. So they don't have a lot of concern there. Now their inflation is still there, but it's not like it used to be. So their concern on inflation is abating. Now they have to start looking at employment, and they have their mandate is to maintain stable employment. Well, jobless claims are ticking up, unemployment is ticking up. We've reached a bottom because we'd reached a historical low going back several decades on unemployment. That's changed. It's bottomed, and now it's starting to come back up. And so now they have concern the other way. Are jobless claims going to continue to rise? And is the unemployment level going to continue to rise? So now they need to take that seriously. And that means if inflation is no longer the bear that they have to tackle, now they have to turn their view over to the joblessness. And that would mean rate cuts. Only until recently did they feel comfortable saying, okay, we're probably going to move in September. So what that means then for grain and livestock. So the market is clearly concerned about what's going to happen with consumer demand for beef. And we've seen that show up in the box beef prices. Our animal protein analyst, Brian Ernest here at CoBank, would be able to go in a much deeper thread on that than I can. But on the surface, that's what's really going on here. This is all about the concern about the U.S. consumer and their ability to spend on beef versus spending on cheaper animal protein or cheaper protein alternatives like pork and chicken. So that's really the story there.
Thing that makes me really nervous from your angle here, if you have such low prices on your commodities like the grains,
Yeah.
and producers have got to pay back their operating notes at the end of the year, I mean, it's hard to get a good opportunity to lock in a price where you can make some money this year.
Yeah.
And I just wondered how tenuous that is going to be on the part of the ag lenders across the Midwest.
It's something we're watching with concern. It's not a new story, I don't think, anywhere in agriculture. We all know what the story is here. We've been on a downtrend really for the past couple of years. We reached new highs in grain prices back when Russia invaded Ukraine, and we've been on a downtrend ever since. Russia came out with a couple of major crops, record crop last year, or near record crop last year, record crop before then, plus a weakening currency. And that changed the story for wheat. And then at the same time, big crops down in South America for corn and beans with a weak real. You just can't compete against that. Now here we are. We had a big crop here in the U.S. We're not short on bushels. So what does that mean for the producer? Well, if you're not going to be able to make it up on price, then you got to make it up on productivity. And right now we're seeing some phenomenal crop conditions for corn and soybeans. It's not for everybody. Clearly, there was some areas that were hit severely by weather. We had those floods in Iowa, in South Dakota, in Minnesota, and parts of Nebraska. Those areas notwithstanding, we also have some drought in some other areas. But on the whole here, I think farmers will have an opportunity, hopefully, cross your fingers. They're going to be able to make up for low prices with higher yields. I mean, you're going to have to grow your way out of it when you're in that situation of persistently low prices. I think there might be some opportunity here with declining fuel and fertilizer prices. But it's those other fixed costs that are really concerning. They don't move so fast. We're talking about costs like land and cash rents. We are starting to see machinery prices are coming down. And so that's a positive. Used machinery prices are dropping. So there is going to be some softening on cost around the margins for the producer, but on your big costs like land and cash rents, that's going to be a tough year. And then labor as well. So I think right now it's, the story's been talked about a lot. This is going to be a year of the farmer working through their cash reserves that they carried over from last year. And what that means then is the lenders are going to see more demand for loans. There's going to be more loan volume. Unfortunately, those loans are happening at higher rates on interest. But again, we got to find a silver lining here. Hopefully, the Fed starts cutting rates and we start to see interest expense drop as well.
At least we're not talking 18 or 20% like we did in the 80s, right?
I was too young when all that was going on for me to remember that, but I remember those stories about what it was like when the grain markets were falling apart and you were paying, double or triple on interest for what you were doing today. So there's always that. That was good news.
As they say in the South, bless your heart. Unfortunately, that was when I got in, and that was pretty bad timing. That didn't work out so well, but
Didn't work out for
that's
a
what
lot of people.
that's why I'm here in this position talking to people like you now. You mentioned equipment, and I wanted to ask you about that. I'm hearing that new equipment sales are really kind of drying up. And in
Yes.
fact, we're seeing quite a few layoffs at equipment manufacturers now. And that's going to kind of spill over too. And I'm sure that's probably having an impact on that unemployment number that you were talking about.
Yeah.
So I just wonder where this all goes from here. That's going to affect all the implement dealers too, heading into next year, right?
Yeah, the rolling stock of inventory is higher apparently, and I don't deal directly in machinery, but that's something that we have here at CoBank is farm credit leasing, and so we hear what's going on with dealers, and the demand for leases is going higher because farmers are trying to save on cost, and it's cheaper in the short term to lease rather than to buy a new machine. So we're seeing that happen right now. Farmers are concerned about their machinery costs, despite the fact that machinery prices are coming down. You mentioned uh, some layoffs happening. That was quite public here recently with John Deere laying people off, and there were some other companies sending jobs down to Mexico too. I'm sure that was probably a decision they've had to delay as far as they can. Nobody wants to do that, but when the farmer is not in a position to buy your product, your materials prices like steel and rubber are still high. Your labor costs are still high. You gotta cut costs someplace to make your shareholders happy, and so we're seeing those jobs leave down to Mexico. Um, yeah, that's tough news for rural America because they're losing jobs now, and manufacturing is a big part of rural employment.
Well, you work with tons of producers, farmers, and ranchers around the country, and just wondered if you had any words of advice to offer as we get toward harvest season and heading toward the winter. Yes, believe it or not, it will get cold again someday.
Right.
But I wondered if you had any words of advice or maybe pitfalls to avoid as
Yeah.
we get into the latter part of the season here, and people have to decide what they want to do with their income before the end of the year.
Yeah, it's always a game of do you chase revenue or do you focus on cutting cost? And unfortunately, in these times, you're gonna have to do both very, very diligently. Every farmer who's been around the block for a while knows how to win that game. Sometimes when the markets are offering you an opportunity to grab a few pennies on the table, you're not going to be getting dollars, but you're getting pennies to stay profitable, then that's what you got to chase. And at the same time, on the cost, there'll be some opportunities there to cut cost. Talking with your landlords about renegotiating rents. If you got to renew your machinery line, there's an opportunity here to do that at a lower cost as used machinery prices are falling. Looking outside the box instead of buying new machinery, you look at used machinery. May require more manual labor to keep it going, but it's going to be cheaper, perhaps, than the cost of maintaining even a new machine with all the electronics today. So you got to start thinking outside the box. Veteran farmers that have been around for a few decades know this game by now. They know about these cycles. They saw this coming, and they know how to get through it. My concern is though those younger producers Like you mentioned, Marlin, you got into the game in the 80s at the worst period. And so my concern would be those younger farmers or smaller farmers that aren't able to spread their risk, or they don't have the bargaining capacity or the size to have bargaining power with dealers or input suppliers and to lower their costs. So it's going to be one of those years this year, probably the next few years perhaps, where you got to kind of dig in on cost and fight for pennies on the table with marketing.
Might be hard to do, but it might behoove you to avoid that temptation to grab that sexy new piece of new equipment out there that has a very high price tag. Can you live without it or not, at least for one more year? Maybe
Yeah.
it would be worth throwing some money at rebuilding what you have and get it up to new standards, if you will, and you could probably do it cheaper. But good advice. Tanner, good to visit with you again. I appreciate that. And hopefully everything turns around and we can get this ag economy leveled out once again. So thank you very much. Hopefully we can have better news next time we talk. Tanner
Likewise.
Ehmke, lead economist for grain and oilseeds with CoBank, joining us from Denver. That'll do it for this episode. Thank you so much for joining us. For producer Brian Hendrickson, I'm Marlin Bohling. We'll catch you next time right here on the Comstock channel. Thanks for joining us on our Comstock YouTube channel. Don't forget you can also find us on Facebook and TikTok as well. Futures trading involves risk. The risk of loss in trading futures and or options is substantial, and each investor and or trader must consider whether this is a suitable investment. Past performance is not indicative of future results.